When it all seems too hard and you are crippled by fear, the best course of action is to simply persevere. Like this poem, the bull market's journey may not be over yet, and there may be upside. And that is according to analysts at Bank of America. So let's take a look. The stock market has defied trade war fears and Turkey's currency woes to notch up healthy gains this month, neutralizing August's reputation as a weak month for equities. Instead, all three indices have rallied as the market celebrates its coronation, at least by some measures, as the longest bull market on record. That performance has triggered some nervousness over whether the market's upside momentum that has carried major benchmarks toward record highs is about to fizzle out. But Stephen Sutmeyer, a technician research analyst at Bank of America, is among those who remain upbeat on the market's prospects. He said that the strength in the market's breadth as gauged by a record high in the S&P 500's New York Stock Exchange Composite Advanced Decline line indicated that stocks have a long way to go before hitting a wall. He says that this suggests market rotation and not a market top. Given the debate about growth topping out relative to value, we find it interesting that the advanced decline line for both the Russell 1000 growth and the Russell 1000 value hit new highs this week. Sutmeyer is referring to the very popular investment strategy of focusing on growth-oriented shares versus those viewed as relative bargains. Since March 2009, the iShares Russell 1000 Growth ETF, and the symbol is IWF, has soared about 329%, while the iShares Russell 1000 Value ETF, and that symbol is IWD, has risen about 215% according to FactSet. The Dow theory, which posits that strength in both the Dow Jones Industrial Average and the Dow Jones Transportation Average means strength for the market, also suggests that the bull market is healthy despite its longevity. As you can see in this chart here, Dow theory recently reconfirmed its buy signal with new highs for the Dow Industrials and the Dow Transports off of the lows from February, April, and June. The volatility backdrop is encouraging as well. The CBOE 3-month volatility index and the CBOE volatility index ratio is holding at 1.10, which is serving as a key support, according to the technical analysts. As long as this ratio remains above 1.10, then the S&P 500 will likely be able to trade above 2,800 and potentially test new highs. Going forward, even if the market's technicals deteriorate and the S&P 500 runs into trouble, its ability to find underlying support in this area will determine whether it will be able to test 3,000 by the year 2019. Fundamentally, U.S. stocks may have robust financial performance to thank for their fortitude, with 86% of the S&P 500 companies having reported quarterly results. Second quarter earnings are up by more than 24% year over year, while sales growth was more than 9%. And it may be also worth noting that none of Bank of America's sentiment barometers, including the bull and bear indicator, as well as the sell side indicator, point to a top in the market as of yet. Looking at this chart here. Meanwhile, J.C. O'Hara, who's the chief marketing technician at MKM Partners, said market sentiment is just right, not too hot, not too cold. So as the S&P 500 is near the highs that it made in January, we find that the current sentiment is not as excessive as it was back in January. And looking at this chart here, the sentiment model, it is in neutral territory, which means it's not too hot nor too cold. So we may have more upside to the market. So for today, that's ChewDog Charts. Thank you.